Good morning. Happy Friday. Mortgage bonds, unfortunately, not off to a great start. So first things first, you'll notice we're looking at the 3% coupon. A few reasons here with rates coming down. Looks like the more appropriate coupon, but more importantly, volume has now began to be greater in the 3% coupon than what we were looking at, which is the 3.5. Now you can always go and click on show more coupons and see the 3.5% coupon. So the change is going to be pretty easy to digest. It should also be noted that this time, for this week rather, the first time that the Fed on their repurchases of mortgage-backed securities have leaned more towards the 3% coupon than the 3.5. All right, stocks are higher this morning, influenced by oil, up over $34 a barrel, up over $1 a barrel. And the correlation has just been unbelievable between oil and stocks. So in other words, if oil is up, stocks usually follow suit. If oil is down, stocks will probably be down. To what degree? How about this? Close to 95% of the time. It's a very high correlation, and we've been following that closely. You know, we've talked about the contango spreads and how that's influencing some of our forecasting. But we know this as well. If stocks are going to be doing well, to a very high degree, bonds don't do so good. And vice versa. When stocks are doing poorly, a lot of that money flows into the bond market. So using the direction of oil prices can give us a real big edge, and that's one of the things we've been looking at. I just want to show you an example here of one of the things we look at here. It's the spread, the contango spread. Now we've talked about contango spreads and prices in the futures market going higher because of storage issues. So when we take a look at this and we look at the darker blue line, that's the contango spread. And what you'll notice here, there's a very good correlation where you'll see an early move up, for example, and then you'll see a subsequent move up or a move down and then a subsequent move down. You know, pretty clear right here. You'll see this move higher, and a couple of days later, a move higher. We start with a move lower, we get a move lower. Very high correlation between the two most of the time. So the contango spreads have been very accurate for us. Now at the present time, they've kind of flattened out a little bit here. In fact, the contango spreads are narrowing, so we've kind of expected this little move higher in the stock market. But going forward, we're going to be looking more closely at this, and in fact, we're going to be putting this on the website first for you folks to be able to share. So this should be an interesting tool for us to use. Okay, let's get to the news of the day. And we start off with GDP. So GDP came in at a better than expected number at 1%. Hey, you know, kind of not a great number, but expecting 0.4. But it's a little bit tricky here with GDP. And this, by the way, was the revised look at the fourth quarter. It was predominantly due to inventory buildup. It wasn't consumer demand, so just kind of stocking shelves. Now, if the consumer demand doesn't come back, then the stocking shelves kind of just dissipates a little bit, and you see a number next time on GDP that will be lower. So we'll see what happens. I'm not impressed with the GDP number. Now, we did get income and spending. They were both up 0.5%, and that income number of up 0.5% seems like a pretty big number. But remember, this is for January, and what happened in December, 2 states raised their minimum wage, 12 states raised their minimum wage in January, along with Walmart. So a lot of this increase in income, in my opinion, is just due to the rise in minimum wage, and it's not really due to people getting raises, the economy doing stronger, so you have to take it with a grain of salt. Now, the number that was really important that the markets like, and of course the Fed, for whatever reason, is their favored measure of inflation, was the personal consumption expenditure, or PCE. Now, remember, comparing this to CPI doesn't really take into account housing or out-of-pocket medical, so it's not as good of an indicator of CPI, but yet the Fed likes it more. So we look at this closely, and here's what we found, is that the headline number, now this does include energy prices, essentially in the past year it's doubled. It's at 1.3%. Still a low number on the headline, but this, like the jump we saw in headline CPI, a lot of that is due to the fact that when you looked a year back before, you were comparing the current oil price to over a year ago's oil price where it was at 100 a barrel. Now oil started dropping, so now you're comparing the current price of, let's call it 34 to where it was about $60 a barrel. So not as big of a drop, but as oil prices throughout the year continue to drop in 2015, we'll start making those benchmark comparisons to that, and that has to start pushing that headline inflation up. Now the core rate of inflation also jumped. It jumped rather large amount. It went from 1.4 to 1.7, a lot closer to the Fed's target of 2 on the PCE. Remember, we're at 2.2% on the CPI. So it's going to be putting some pressure on the Fed. The jobs numbers, however kind of masked they are of the real story, are strong in the Fed's eyes. And before they had cover because inflation was so low, so we've got to get inflation near 2%. As this trend may continue, now at 1.7 on PCE, 2.2 on CPI, the Fed's going to be closer to its 2% target, yet their hands might be tied and they may not be able to hike. So this is going to get very interesting. Bond prices, as you can see, not reacting great because inflation is the enemy of bonds. Let's take a quick look at the charts. Now, again, we are looking at the 3% chart, so some new Fibonacci lines here, but you can see that the levels are pretty darn good. We're looking above the 25-day and battling to hold on to this Fibonacci level in this 25-day. We break beneath this, and it could be a little bit of trouble. A lot of that will depend on how stocks do. 10-year Treasury, again, in this big range, susceptible to whipsaws, all the way up to 177. Again, man, this has been vacillating quite a bit. Look where we were here. We're at 166 2 days ago. Now, just 2 days later, 176, 170. Call it 177. So a lot of big moves, and that may continue just because this range is so wide. So, all right, hope you guys have a wonderful day today and a great weekend. We're going to begin the day today by floating and watching this carefully. If there's a need for a lock alert, of course, we will get back to you. But we're starting off with a floating stance. You know, we did do an alert to lock a couple of days ago. We've lost a little pricing today, but we want to see if these floors can hold. So I'm going to be a little patient here, see if this Fibonacci and 25-day moving average holds before jumping the gun. All right, hope you guys, and also stocks, they may come back a little bit here. We're up 9 on the S&P. You know, oil has started to, come back in a little bit. Maybe stocks pair off some of their gains and come closer to the flat line. All right, hope you guys have a great day. Bye-bye.